Welcome to The Real Money Show. My name is Jeremy Wiseman. I'm joined with Jerry Correia. The phone number 1-866-274-9570 or 1-877-8-SILVER, and the website guildhallwealth.com. Today we're going to talk about Basel III Rules. What is that? Is that from Austin Powers? No, it's about banking, and we're going to get into some details about that, remind you of how important it's going to be with the new Basel III Rules and gold. We're also going to get into some physical metal demand. We had a great interview last week with Steve St. Angelo, and I thought it would be great to bring another recent article of his just talking about just how much demand for physical gold and silver there has been throughout the world in the last year. And as well, we might as well talk about Bitcoin, right, Jerry? Because it is it has been experiencing a decline, and for some reason or other, the mainstream media is still attaching this comparison between gold and Bitcoin in there. So maybe we'll start with that. Again, the number 1-877-8-SILVER, the website guildhallwealth.com, and let's jump into this Bitcoin decline. First of all, was that expected?
Yeah, I think it is expected to see the volatility. We're getting a lot of attention from the mainstream now. A lot of actors in the market, some celebrities in the market now getting on board and voting. Elon Musk is one of them, having a lot of influence in the Bitcoin sphere, Dogecoin sphere. But this is expected because this is still, the cryptocurrency space is still very young, only about 10, 12 years old. So we have to anticipate these type of whipsaw events. So it's important as well for us to be observant of this, not really discount it or dismiss the market per se, but just understand, okay, these are the other counterparties involved in Bitcoin. When discussing the comparison, this gold 2.0 is Bitcoin, the new gold, and it's very important for us to bring these events, what's going on with Bitcoin, and then compare it with gold.
Well, there's been a bunch of articles coming out across Bloomberg's desk, and they seem to be, they're kind of hit pieces actually on crypto and Bitcoin. For some reason, they've decided to pile on to that. But one in particular, the title was Bitcoin's claim of rivaling gold as a portfolio hedge loses luster. So I thought, hey, let's bring this to the attention of our audience. Let's kind of throw out that comparison again and see where it lands. The way this article starts, it says a one-day swing of 31%, a slump amid a jump in U.S. inflation, right? Gold is rising on those expectations. Ever more critical regulatory scrutiny being another one, and Bitcoin delivered all of these in the past few days, undermining its claimed role as a portfolio hedge rivaling gold. I read another one somewhere, Jerry, was saying it's not performing very well as money, in the sense that you can't really buy anything with it. I mean, we proved that with Elon Musk. We've had our own issues with it over time. It's slow. It's becoming more costly. It just seems a very difficult thing to actually be able to spend Bitcoin. The other side of it, of course, is the volatility that's happening, which makes it not a place to store value in that regard. Now, I guess we could argue, or someone could argue, hey, if I bought it at 15,000 and it's trading at 40,000, I'm still well ahead. I've kept my value. But nonetheless, there is that volatility. Let's talk about the fact that the one claim on crypto, again, we don't have a problem with crypto. There's lots of money to be made up and down, however people are making the money. Sure. It's fantastic. But in terms of just really comparing it to a place to store wealth, that's the question, right? So let's talk about the fact that we've seen the volatility in the market. And the major claim on crypto is that there's a finite amount of it. What is your take on that argument alone, that there's only so many, let's say, coins, and I put that into major bolded air quotes.
Mm-hmm. And that may be the case. There may be a finite amount, but there's no finite amount of scaling and how fractionally or how divided Bitcoin can be. How divisive is it? You can really go back, move that decimal point a few thousands over and create a fraction of a Bitcoin. So this is where it becomes iffy thing. This article that you brought is is a good one, and I think they hit the nail on the head with regards to not calling it a hedge. Your hedge has to be something that can defend against things like inflation, a very hot topic today. And it's clear your Bitcoin will not be a hedge against that. It won't be a hedge against other tailwind risks. It's more of a lottery ticket. And for us, we see that as a you gotta have a card. You have to have your ticket to be in the market.
You're talking about crypto?
About crypto,
right?
For some topside potential. Everyone wants to make money.
Right.
But it's just not your hedge against banking failures, financial calamities, inflation, things that gold handle.
Well, let's talk about what you just said about the decimal points. Do you think that would maybe add to the volatility of it? Because the idea is if Bitcoin's trading at 50,000 plus, but you can still buy $500 worth, and it's very easy to buy and sell it, then the tendency to treat it like, running from table to table at a casino is there. You don't like something, I can sell my $1,000 worth or my $20,000 worth, whatever table you're at. Are you at the small table or the big table? Yeah. But you can easily just do that. So unlike gold, for instance, where you buy an ounce, and it's not so easy. It is liquid, yeah. But to sell it, you have to get in your car, drive it somewhere, right, and sell it, or pick up the phone and make that call and make that sale. So I just think maybe they're both as liquid, but perhaps the infrastructure to be able to buy and sell rapidly, yeah. On the crypto, plus the fact that you have these buying it in these increments that are way below what its actual cost is, wouldn't that add to the volatility?
It certainly should, and I liken that when you fraction a Bitcoin, it's sort of like having unallocated gold. You have so many shares and so much leverage in the market, and as this market adapts and becomes very much like a futures market, you have ETFs, you have now inverse Bitcoin ETF, so that if you want to short Bitcoin, you can go ahead and do that. Add in all of the fractional Bitcoins out there, certainly going to add a lot of volatility going forward. Besides that, the fundamentals right now. Early this week, the U.S. Federal Reserve Chairman spoke, Jerome Powell, and he got on the mic and he talked about Bitcoin, how it was not a good form of money because of the volatility, because of the swings of up and down. It's not a good form of payments, rather. And that the U.S. is going to be introducing its own white paper for a Federal Reserve digital currency. And this is something that has been discussed. Gerald Celente was on the show a couple weeks back, and he talked about competition. Central banks do not like competition. So as far as headwind goes and volatility, I think right now the volatility will come from the central banks and massive countries like China.
Oh, they just cracked down. I just saw, just as I was printing these articles off, there was another article off that they're cracking down on mining in China. So
same headline. They're just saying it over and over again. They have been saying this for a while now, but that's it. You have one country with so much influence on your investment, if it's an investment or your holdings or your asset. Too many counterparties at this moment for me to call it a hedge. So in order for you to call something a hedge or wealth insurance, it has to have zero counterparty risk like gold.
Well, Gold Telegraph mentioned this in a tweet several weeks ago. There's 11,000 cryptocurrencies. There are 180 fiat currencies. There are 118 elements, and one element has been used for money throughout history, and that's gold. So you've got a 5,000-year track history in gold. You have several years track history for digital currencies. Last week we were talking with Steve St. Angelo, and he was talking about the energy impact, which was the excuse that Elon Musk used to that's why we're not using it, because there was an energy thing, as if he didn't look into that way before. I mean, come on, buddy. Yeah. You're a very smart guy. You already knew that. But it was a good reason. It was a good excuse at the end of the day as to why they didn't. So, at the end of the day, I don't think, in concluding this discussion, I don't think that we're looking at a replacement for gold in cryptocurrencies. I think one has the track record, one is an innate value. Innate value meaning you can melt it down, turn it into something else. It's always had value. It will continue to have value, even if you're adding 2% a year to the world supply. That is not a lot in comparison. So I think this is not about storing wealth versus speculation. I think that's maybe where we're leading with it.
Yeah.
One is about I would say one is about the future, and one is about protecting what you have and is potentially the bridge to the future.
Sure.
Right?
Exactly.
If you have to convert your money into a Fed coin down the road, are you going to be converting it from a crypto that we don't know what the value is going to be, or do you convert it from the gold, which you know is protecting your wealth over these periods of time? So don't like the comparisons. I think there's too many differences to really keep that comparison going. But we thought it was a good argument to just bring back to the table, since it seems that the mainstream media is just slamming us back together to have that discussion. So, hopefully that added a little bit to the thought process there. The number 18778-SILVER, the website guildhallwealth.com. In the next segment, let's talk about unallocated gold. Maybe some of the headwinds against gold. Is unallocated gold a good thing for gold right now? A bad thing for gold right now? Are we looking at the gold pool collapse of 2021, the London gold pool collapse like we saw at the end of the 60s? Let's get into the gold market. Again, 18778-SILVER, the website guildhallwealth.com. You're listening to The Real Money Show on Global News Radio, 640 Toronto. Welcome back to The Real Money Show, the number 18778-SILVER, and the website guildhallwealth.com. My name is Jeremy Wiseman. I'm joined by Jerry Correia, and we're talking about physical precious metals. Now, just before break, we said we're going to talk about Basel III. Well, the last time we spoke about this, Jerry, was actually March of 2019. This was a story that was breaking and now is coming back into the fold. And this is talking about the Bank of International Settlements. And the mandate of the BIS is to serve central banks in their pursuit of a stable financial system. The new Basel III rules says gold is a zero-risk asset. In other words, gold has re-entered the financial system and can now be used 100% as collateral for banks to assist in their overall stability. So what this is talking about is that back in 2019, we knew that the new Basel III rules were going to come in at some point. Well, here they are. They're about to come in, so it's time to start talking about it again and the impact that these new rules could potentially have on the physical gold market.
It directly relates to the physical gold market, and in contrast on how it relates to the unallocated gold contracts. Coming up next month on June 28th, a new regulation will be set into place that disvalues unallocated gold paper contracts held against lendings. So the key principles of Basel III is that the bank needs to have certain capital requirements, about 7% in good money. So the Bank of International Settlements basically says what is good money, what is bad money. We know cash is tier 1 capital. Now gold will be tier 1 capital as well, 100% worth going towards to deleverage their lendings.
So again, up until next month, gold was taken away out of the tier 1 asset. Now it's being put back into the tier 1 asset as good as cash. So there's cash and there's gold. How was it used before when it was not a tier 1 asset? What did the banks need to have? Did they have to have physical? Could they have paper? And what good was it for? How much could they use against their books on that?
They would be able to use unallocated gold.
Okay.
And it would be weighted up to 50% of its value.
Okay.
So if you had 100 contracts, 50% of that would be going towards the good money on the balance sheet. So I liken this very much to just for everyday understanding, like a mortgage. If you needed to purchase a property, you put down a down payment. You need some good money down, 5% down, 20% down, and then you can finance the balance and own a house.
Okay.
Similarly, the banks need to have a very strong balance sheet in order to deleverage their lendings, all of their lending. So they need to have something there, and it needs to hit the requirement of 7%. So this stress test is coming up in June 28th.
So before, if we're using the home analogy, before they could use 50% of their unallocated paper gold holdings, 50% of it as collateral, as something to put up to things. So if you had $100 million in gold, paper.
Paper.
You could use 50 million of that in paper to use as collateral for things.
Yeah.
But now they're moving that from a 50% allocation of paper to a 100% allocation of the physical.
That's right. So yeah, exactly. So like previously, banks could hold gold on their balance sheets, all unallocated. And the key takeaway here is that they're removing the value of unallocated gold. And this is going to put pressure. So they're disvaluing the unallocated gold that is on their balance sheets.
Right.
And you can only hold now tier 1 capital, and which is the physical gold. And that is the difference between unallocated paper gold and physical. Physical will last. Physical is the real money, and it always comes back to physical, the real tangible asset. That is what is intrinsic and will last. This is the enormous opportunity we've seen. We reported this back in March of 2019, as you mentioned, and ever since then, gold is up about 36%, and this trend is only going to continue.
Okay, so for those who are just joining us, the number 18778 silver, the website guildhallwealth.com. We're talking about the Bank of International Settlements. They've been doing this for a while. They've known the banks have known that this is going to be coming, and what they're doing is they're turning gold into a tier 1 asset. Banks that had unallocated gold now have to have allocated physical gold. This seems very, very important to the physical gold market. We know that gold has moved up significantly over the last couple of years. Would you say a big part of that is because these banks are getting in?
Yeah, for us, it's definitely the awareness of what banks have to acquire now, and it's woken people like us up who understand the reality of the physical versus paper markets, and to get it while the prices are low, while you have access to the physical.
So if I'm looking at the gold market for the first time, Jerry, I'm thinking this would have a major impact on gold. Obviously, not just in a symbolic way of saying, hey, gold is a tier 1 asset. That should give me something to think about, especially in the face of cash and how much money is being printed and the value of the dollar going down. I would think, okay, getting it to a tier 1 asset is just step 1, but now out of the tier 1 assets, it's probably the better of the two, gold versus cash. Going back to our first discussion, cryptos are not, I'm going to assume cryptos are not part of the tier 1 asset as of yet.
That's right.
Okay. Maybe they'll try to get the Fed coin onto that.
Probably.
Maybe one of these days. But we don't know the impact yet of what this is going to look like when those rules come into play. A lot of times people in our industry would say, okay, it's going to be happening on June 28th. What is this going to look like? What do you think it's going to look like?
Well, it certainly shows the importance of gold, number 1, but we're talking about a stress test here, which has to do with the solvency and the strength of the entire financial market, the global financial market, the banking system, and meeting requirements and becoming compliant a month from now. So this is very important, and it shows not only the importance of a potential default, perhaps, and a systemic crisis emanating from, it could be from Europe. I mean, if someone sneezes over the ocean, we catch the cold. This is how important this is. We will all remember 2008, and we're
2008. What? What happened in 2008?
Well, ever since 2008, we've added even more debt to that debt problem.
I can't believe how in 2008, at the end of the day, by the time Bernanke was on the cover of Time magazine, how much people didn't care about how much money was created. I know gold and silver went up significantly because of the thought of inflation that could happen as a result. And you look back and you think, what a simpler time that was. Now you have, Canada has printed, $360 billion very quickly. They're printing tens of billions of dollars a month on the Fed's balance sheets every month. So yeah, obviously having some gold as a basis for the banking system seems prudent at this point. The question really, again, I'm going to hammer back to you, is what kind of impact is that going to have on the price of gold when this finally hits? Now, let me add a little bit to that, because there was an article by Chris Powell, and we've had him on the show once, from GATA. and that's the Gold Antitrust Action Committee. And just listen to the first part of this article. Pending the Basel III regulations emanating from the Bank of International Settlements could destroy the clearing and settlement system for unallocated, that is, paper or imaginary gold and silver. The London Bullion Market Association and the World Gold Council warned the Bank of England this week. Now, this was just from a week ago. In a 58-page protest submitted to the Bank of England's Prudential Regulation Authority, the LBMA and the World Gold Council complained that the net stable funding ratio provision of the Basel III regulations would require the London Bullion Bank to hold funds offsetting 85% of the value of unallocated gold, and they hold for their customers, and the banks could not afford this. So basically, they've offered up a 58-page protest saying, we can't do this. We can't. We cannot accommodate this. We can't comply to this. So again, how is this not going to be explosive for the price of gold and silver?
This is going to be very explosive. Just knowing that the banks now, through these new changes, Basel III rule changes coming up, it's going to provide the banks with an enormous opportunity to address the debt, to potentially pay off majority of the debt, and makes gold very attractive to accumulate before this event and exchange inflated dollars for physical bullion. So this is the stage for silver and gold, because we know that gold is going to be appreciating because of this, and then we link the silver to gold ratio. It depends on how much debt that they want to pay off. It really depends on the gold price. If they need to pay off more debt, well, they may have to do a revaluation on that gold price so that they'll have enough gold at a specific price to guarantee and back up all that debt.
Ooh, okay. So I think you got it. I think what we figured out here is that if it's important enough for the Bank of International Settlements to say, here is your tier one asset,
Here's your ticket.
you've got a motive on the part of the major banks to actually increase the price on gold because it's their collateral.
This has been that argument for $10,000 gold, going back almost 5-10 years. We've been hearing about this erroneous claim that gold can go to 10,000. I mean, me as a gold guy and FX trader, I scoffed at the idea, but when we understand the math behind it, it makes total sense, especially when you come down to how do we back up, looking at the down payment, how much good money do I need to buy my house? Well, you need a lot of good money with all that debt you have on your balance sheets.
Good money is real money, and that is gold and physical silver. The number 18778 silver, the website guildhallwealth.com. If you want to acquire physical gold and silver for your registered account, it's very simple. Go to the website. We offer a vehicle where we physically segregate the product, and each account segregated so it's separated from all other accounts at the vault, and then it's fully allocated to the client. So the client receives the serial numbers of the specific products that they're holding in their account, whether it's an RSP, TFSA, an RESP, a LIRA, a LIF, a spousal RSP. And so what this means is you actually have direct ownership of your physical product in the registered account. Now, that's something we've been offering for over 5 years, and it's something now that the Bank of International Settlements, it appears, is actually demanding of their banks now. So nice to know we were ahead of the curve. You've been listening to The Real Money Show. We'll be right back. The number 18778 silver, the website guildhallwealth.com, and you're listening on Global News Radio 640 Toronto. We've been talking about the new Basel III rules and the fact that gold is going to become a tier one asset as of next month, meaning that the banks have to hold physical gold, no longer having to settle with just unallocated or paper gold. They actually have to have the physical inventory. But the bonus for them is that they can use that physical inventory as 100% collateral on their books for whatever else they're doing, loans, etc. Jerry, anything else to add on that subject?
Yeah, just to really summarize about these new rules for banks on June 28th. Well, previously, banks could hold gold on their balance sheets in the form of unallocated paper contracts, gold contracts, without holding physical gold in tangible forms. These paper contracts were considered as good as gold when it came to determining how much capital the bank needed to maintain on its balance sheet. So under the old rules, there was little incentive to hold physical gold. as it was only valued at 50% of reserve purposes. Basel III rules move physical gold from being considered a Tier 3 asset to be considered a Tier 1. In summary, regarding these new rules for banks coming up in June 28th, gold in unallocated paper contracts will no longer be considered an equal asset. They're taking the value away from unallocated holdings. For this reason, banks using paper forms of gold to help meet reserve requirements will have to convert those positions to physical metal, or else risk becoming too undercapitalized to continue to function. So we're talking about major banks and institutions, and we have to kind of zero in on our own personal holdings. Do we have paper certificates in our holdings? Do we own any ETFs? Do we own some other form of gold proxy to represent physical? Well, this is a major problem when you have banks now rushing, trying to convert these unallocated gold contracts into physical. We should be doing the same thing, but the problem is there's an imbalance between unallocated gold and paper gold contracts. We talk about the physical silver. How many shares of silver out there for every 1 ounce of gold, 1 ounce of silver? It's 1,000 to 1. Similar for gold, it's about 100 to 1. So there's a huge disconnect between the real and paper. The rush to real is on.
The rush to real is real. The number 18778 silver, the website guildhallwealth.com. Well, speaking of the move into physical product, Steve St. Angelo put out an interesting article over the past week just talking about the demand for the actual physical metal. And he was saying that of the 201 million ounces of total physical silver bar and coin demand in 2020, the United States accounted for nearly 40% of that, 78 million ounces. Canada bought 7.9 million ounces. Now, this is the interesting part, and this goes to what you were just saying. While Americans purchased a lot of silver, they don't buy that much physical gold and physical silver. Less than Germany. In other words, Americans purchased 2.2 million ounces of physical gold compared to 5 million ounces of physical gold for the Germans. So he's just talking about, it's interesting that, because of their history of Weimar Germany and hyperinflation, they have a stronger inclination to the physical versus where a lot of people have an inclination towards ETFs. Even if it's physically backed, it's not directly owned by them.
Yeah, a different mindset totally we're seeing between the East and the West. And we hear about it, we read about it all the time. We even meet people all the time regarding, it really comes back to their history and what they've seen, what they've experienced in the past, whereas Westerners tend to like to log into their computers and see.
You mean like Americans or North Americans versus Europeans?
Yes.
Yeah,
North Americans. We tend to like to log in and trade our assets. So if it's easy, we want that, but we really don't understand what the gold has done in the past for a particular person or a group of people or even a country, how gold has literally saved some civilizations. We haven't seen that same type of attitude here as much in Canada.
Now, he puts in an interesting data point at the end. The total American physical silver investment from 2010 through 2020 was a little more than 1 billion ounces compared to 21 million ounces of physical gold. So what he's talking about there is the idea that because silver is so much less expensive than gold, you have so much more buyers into the physical silver market, and this is a very, very good thing. In other words, Americans have bought 46 times more physical silver than physical gold. And so looking at the silver story, the fact that only 1% or less of the population are actually buying physical metals, what happens when inflation is rearing its ugly head and people are saying, I need to get into something that's actually going to store value. I don't know if my stocks are going to keep up with inflation. I don't know if my property, these excess properties I have, are keeping up with inflation. I need to get that real inflation hedge, gold, physical silver. What happens when you have that less than 1% of the population moving into that physical gold and silver? That is fireworks in my mind.
It certainly is. When you have the potential tantrum of inflation, and then you have a potential tantrum with them trying to taper their balance sheets, which is another tantrum, your stocks, your paper assets are going to get burned, frankly. That's why you want to have a position. And I know a lot of Americans follow the silver gold ratio. So the silver does offer a little bit more topside potential. So you get best of both worlds. You have hedge and you also have participation on the top side, because when it takes off, we saw this in 2010 to 11, where silver went up like 4 times from '08 to 2011.
Well, speaking of topside potential, let's look at where the prices of metals are headed, how people can profit in this market. The number 18778 silver, the website guildhallwealth.com. We're going to get to all of that in the next segment. You're listening to The Real Money Show on Global News Radio, 640 Toronto.
You are listening to a paid commercial program. Unless otherwise identified, the guests on the program are employees of or otherwise represent the advertiser. The opinions expressed therein are those of the advertiser and do not necessarily reflect the views and policies of Global News Radio 640 Toronto.
Welcome back to The Real Money Show, the number 18778 silver and the website guildhallwealth.com. We've covered a lot of things today, mostly talking about this idea of gold moving into a tier 1 asset. This is something that we started talking about back in 2019, and we do have a video of that up on our YouTube channel. So we definitely recommend getting caught up on the Basel III rules and how they're going to impact gold. As well, we've also been looking at just the impact of the physical demand anyway in the gold and silver market. We know that that's been continuing to rise. And over the course of the last 5-6 years, we've definitely seen a trend towards direct ownership. This idea of if you can't hold it, you don't own it. It's something that we offer here at Guildhall, and we do subscribe to that idea of if you can't hold it, you don't own it. So when it comes to buying physical and storing physical gold, especially in registered accounts, the key factor is that the product is fully allocated to the client and they have the direct ownership. Now let's quickly just talk about what we're seeing in the gold and silver market right now. We've seen gold make a nice move up. We're almost $200 off the bottom, Jerry. And I think part of that is because last year it was such an explosive move after between March and the end of summer that there was some technical building up that had to be done, filling in the gaps, etc. And here we are, gold is basically at zero on the year. We're just almost in the black. And if you look at where gold's returns over the years, its average has been about 11%. Last year it was up about 23%. The year before that it was up, I think, about 17%. So if we take a 20% gain from here, we're going to be up another couple $100 plus, which I truly believe we will be at. Now, so I think that's a good thing. I think while all other commodities are seeing those double digits, you have an opportunity here to acquire some physical gold before we make those bigger moves. Now, gold was pressing higher. We kind of saw once it hit that 1775 mark, you could really feel the psychology of the market change. There's a sense that, we're going to hit 18 here. And I think we've moved up $100 within several weeks of that move. The next big constraint on silver is now, again, around that 28 range. I think we need to hold the 28 range. I think you need to see some creeping up on that 28, starting to push up against that 29 again. And then what will happen is you'll see that organized retreat on the part of the banks. They seem to have a motivation to keep the prices a little bit contained because gold is the barometer of the health of the financial system. And so we don't want to see that skyrocketing, right? Because that would be very, very bad for the financial system and people would just run out of stocks because they'd go, what's wrong? What is going on? That gold is going so high. I better be getting out of cash and getting into physical gold, etc. So there's this organized retreat that happens. I think the next retreat on silver is going to be past $30 an ounce. I think that's going to be a big move. What do you think?
Yeah, I certainly see that. Starting at the gold price, gold prices peaked last August and bottomed out early in the year. But now we have retraced about 50% of the losses. So we're on its way back. It's built a very bullish channel. And gold, once it breaks over the 1900 mark, it probably can leap back up to 1960 real quick. And once it confirms and holds the 1900 level, silver will definitely, in my opinion, be well above 2930. Andrew Maguire actually referenced the Basel III rules, and as a result, he sees these rule changes coming up next month to be a massive boost for gold, actually a $500 boost for gold, and to $10 to $12 boost for silver over the next 12 weeks or 5 months. So that's a very short term turnaround. But yeah, you're right. As far as the Fed goes, we know every FOMC meeting that happens every month, that could be a very good buying opportunity for precious metals investors, because the verbiage that they're using to try to quell the precious metals demand and the allure of precious metals is to talk about tapering their balance sheets. So write that down, take notes. That is exactly the verbiage that is being spun right now from the Wall Street Journal, various financial reporters. They're using the taper, but we remember that when they tried to do the taper, the market nearly went upside down. The stock market was bleeding. So either way, if we have inflation or we have tapering the balance sheet, there's a tantrum on both sides. So remember, on every single dip, you buy your physical metals, and you hang tight, you hold it, and you position yourself for more topside.
Yeah, look, we're not financial advisors. We're here telling how our experiences of the physical gold and silver market. We are experts in the gold and silver market. So definitely speak to your advisor, get their advice. But we truly believe, and many others believe, that you should have 10-15% of your net worth in physical metals. And just speaking of that, if they're raising the requirements on mortgages in Canada, what happens if something happens on the interest rates and those start to rise, but gold is rising at a faster clip? That's your hedge, right? It can certainly act in that way. So you've got the Fed on the one hand, they've backed themselves into the corner. Whether they start thinking that they're going to raise interest rates or they're going to taper, there's going to be a tantrum. It looks like they're itching for the market to tank. I don't know why, but I just get that sense out there. We have the Basel III rules coming in saying you banks better have your physical gold, but we're gonna up the ante and make sure that, hey, you can have 100% of the collateral against that if you do that. And you've got this movement into physical gold because inflation is everywhere and it's so obvious. Jerry, some last moments. What do you think? Price rising, is Andrew Maguire correct?
He ultimately is correct. You never know with the timing, but he's 100% right. And last remarks from myself. I guess it's more anecdotal. Of a client of mine. He's a really good friend. He's a CPA. He's an accountant, managing funds for a lot of high net worth physicians. He's a great neighbor of ours, and he basically is advising his clients because he can offer that financial advice. He is a CPA and a CFA. Hedge if you have real estate exposure, more than 3 doors, as they say in real estate. Hedge your debt, hedge the mortgage with silver. That's what he's done. He's recommending all of his clients to do the same. So that's some advice from a professional. If you want to get in touch with him, I'll be more than happy to share his information. But that's one professional doing something in light of all of these negative realities. He's actually telling people to do something tangible. He's actually providing some avenues to defend against what's coming.
And I think that as well, the idea of sell in May and go away, this might not be the year for that. Stay on guard, be nimble, keep an eye on the gold and silver market, make sure that you're ready for some action there. You've been listening to The Real Money Show, the number 18778-SILVER, the website guildhallwealth.com. Thank you so much for taking the time to listen to us this week, and we can't wait to speak to you again next week on The Real Money Show. And you've been listening on Global News Radio 640 Toronto.